Hello, my name is Jennifer Heward, and I'm a bilingual senior customer success specialist with Snap Projections. And joining me today is Lee Martinson, our manager of customer success. Today, we're going to demonstrate how to create a new plan for our fictitious clients, Jay and Barbara Steele. And in creating this plan, we are going to ask some very important questions about retirement, such as how long will your money last and will you be okay? How much can we spend so we don't run out of money? And if we are currently saving X amount of dollars, will this be enough? The financial planning questionnaire has been completed, and a copy will be available under the article of this webinar. And don't hesitate to put this into practice following the webinar. We will now move over to our Snap Projections homepage. And from there, we are going to click on Login. And this will bring me to our client list page. Now, normally we would hit New Client, but I have already pre-populated some of the fields. So I am going to click into our fictitious clients, Jay and Barbara Steele, to get into their plan. Okay, so we are going to assume that we are creating the plan from scratch. So to do that, we go into Scenario Setup, and we will go into our Client tab. So you will see that the client's name is Jay, last name of Steele. His date of birth is 1965, May the 1st, and he resides in the province of Ontario. All right, and Jay is married to his lovely wife, Barbara Steele, and her date of birth is 1967, June the 1st. So we have a couple of options here. We can click Next to move on to the next page, or we can go to our left side navigation menu and we can just click on the next page, which is the general page. So from here, we can see that we are in the year of 2025. Our clients' retirement ages are age 65 for Jay and 63 for Barbara, and this is in accordance with their financial planning questionnaire. And we are going to show the projection until the age of 100 for Jay, and that will be age 98 for Barbara. With respect to the inflation rates, these are based on the FP Canada guidelines. And with respect to the rates of return for cash, fixed income, or equity, we can always use the FP Canada guidelines by clicking on this. And if we'd want more information as to what that is, we could always click on What's This to get more information. But for the time being, I have gone with my very own defaults of 1% for cash, 2% for fixed income, and 5% for equity. And just so you know, I have reduced these to take into account the portfolio management fees. All right, and if you did want to save these for future scenarios that you might be working on, you can do that here as well. So moving on to the next page, we are at the expense pages. Now you will know that there is a page, if you look up here at the top left-hand corner, you will see that there are pages for both Jay and Barbara. Right now we are on the expenses for Jay, but this is the base expenses. So these are what we would consider to be expenses relating to the cost of living. So we're talking about transportation, groceries, accommodation, that sort of thing. Now, they have indicated to us on their financial planning questionnaire that they would like a combined annual amount of $115,000 per year in their retirement. And then we can also add an additional expense, which we've done here. So they have indicated to us that they would like to take a vacation. And this vacation will cost $10,000, and it is joint. Okay, so it will be covered by both Jay and Barbara. And we've got the inflation rate of 2.1% here. And the from age, we would indicate that if it was going to start, let's say in the future, but because it's going to start now, we can leave that blank. And that is going to run until the to age of 80. So that's Jay's age 80. And the frequency, so if we click anywhere in this box, we'll get a drop-down menu. And our clients have indicated to us that they would like to take these vacations every 3 years. So we've clicked on that. And we've also indicated in the highlight, if you want to know what that means, we have question marks on beside most of our fields. And you can click on those question marks to get more information. But we're going to say, yes, we want to highlight so that in our charts, we will specifically see these vacations. Okay, so moving on to our next page, which is our income page. And we are on Jay's income page. So Jay has employment income of $90,000 per year. This is not joint. It is indexed to general inflation. Now, we could put in an amount here. We could put 2% inflation if we wanted. And if we wanted to revert back to general inflation, all we have to do is hit our backspace key, and that will bring us back to general inflation. And then we have types of income here, and we know this is employment income, so we've selected that. The income is taxable. Okay, so yes there. And it is also RRSP eligible. So we've selected yes there. Now this is he's currently earning this income. So the from age, we will leave that blank. And the to age is going to be the age of 64 because he is retiring at age 65. So if we wanted to be more specific with the to age, we could always click on this gear icon, and we could actually put in the exact date that our client will be working till, and then the system will prorate that income within the plan. Okay, our client also has a defined benefit plan. Okay, and what he has is defined benefit pension plan. It's going to start at age 65, and you'll see here that we have a before age 65 section and a from age 65. So being that he's taking his pension at age 65, we will move over to that amount, and that amount is $55,000 for the year. The survivor percentage is 80%, and the indexing is 2%. Okay, and prorate, we will leave that at no. Okay, so that is the defined benefit plan for our client Jay. Now we're going to go to Barbara's income page. And okay, so what we have here is we have her employment income of $110,000 a year. It is not a joint earned income. The indexing is to general inflation. Employment type is employment. Taxable, yes it is, and it is RSP eligible. From age, it's currently being earned, and it's to age 62 because she is taking her retirement at age 63. Now, our client Barbara does not have a defined benefit plan, so we can delete that by clicking on the garbage can right here. Okay, and it's a confirmation here that we want to delete that. And okay, so no defined benefit plan for Barbara. Moving on to our assets page. So we're on Barbara's page right now. And whoops, what did I do there? Okay, sorry. So we're on the assets tab of the financial assets section. And based on Barbara's financial planning questionnaire, we can see that she has an RRSP worth $375,000. The cost is not applicable to a registered plan. The type is RRSP RIF. It is not a joint asset. And when we get to the asset allocation section, it must total 100, but we have got 0% cash, 40% fixed income, and 60% equity. And so that gives us a total rate of return of 3.8%. Barbara has also got a tax-free savings account worth $85,000. Again, the cost is not relevant to a registered account. The type, tax-free savings account. It is not a joint asset, and we've got the same asset allocation for that tax-free savings account as well. And we've also got a non-registered account right here worth $20,000. We do need the cost on that. It is a requirement for non-registered. So the cost is $18,500 and the type is non-registered. And this is a joint account. So we've got yes indicated here. So this will also appear once we move on to Jay's assets page. And we've got the same asset allocation being 40% fixed income, 60% equities. Now you will see here that we have a few buttons under our actions column. So the icon, the gray icon with the up arrow, is just if you want to change the order of your assets. The green one is to copy the asset to the spouse, because oftentimes our clients will have the same type of accounts. So that saves you some inputting there. And then the blue icon with the right arrow button is to move the asset to the spouse. So perhaps you entered it in error and it actually belongs to the spouse. We can move it over that way. Okay, so moving on to Jay's asset page now. Like I said, he has similar assets. So he has an RSP worth $150,000. It is not a joint asset. And he's got the same asset allocation of 40% fixed income, 60% equity. His TFSA is worth $85,000. And got the same asset allocation there as well. And then we have that non-registered account worth $20,000 with a cost of $18,500, and that is a joint account. Okay, so that shows we only had to enter that under one of the spouses, and because we've designated it as being held jointly, it will appear under both of their pages. Okay, and that also has the same asset allocation. Now, you'll see some other tabs up here, and these are relating to registered financial assets. So, for example, if I click on TFSA, this is where we can indicate our client's TFSA contribution room. So for 2025, it's $7,000, but perhaps they haven't contributed every year since they were 18. So, you know, if you have a statement from CRA indicating that their contribution room is more, you could add that here. Then moving on to the RSP RIF tab, the RSP contribution room for 2025 would be calculated as 18% of the client's previous year's income, but in this particular case, we have a copy of the notice of assessment from CRA, and we know that the client has contribution room of $20,000. And because he belongs to a defined benefit plan, he also has a pension adjustment. So we've indicated that amount here, and that's $9,000. Now moving on to Barbara's registered tabs, under TFSA, she also has TFSA contribution room of $7,000, and she has RSP contribution room of $20,000 per her notice of assessment as well. She does not belong to a pension plan, and therefore she does not have a pension adjustment. Okay, so now we're moving on to the real assets. Okay, so we've got financial assets under this page as well as real assets. And our clients, Jay and Barbara, own a primary residence, okay, and it is worth $550,000. The cost is not relevant here because it is the primary residence, so there's no deemed disposition upon liquidation. The appreciation is at 2.1%. Now there is a column here for future purchase age. So let's just say that in the future, our client was planning on buying this house. We could set a date for which they might be making that purchase. There's also a future sale age. So if our client knew that they were going to be selling this residence in the future, we could put the age here as well. We do indicate that this is owned jointly, and the capital gain tax would be not applicable. So the answer there would be no. Moving on to our debts page, our clients, Jay and Barbara, have a mortgage on their property, and the balance owing on that mortgage is $72,000. They have an interest rate of 4.8%. Now, let's say they were going to be purchasing a home in the future and taking a mortgage in the future. We would put the future start age right here. In terms of the repayment options, we've selected interest and principal for our clients, and we indicate the monthly payment amounts. So they are making payments on this mortgage of $1,200 a month. The mortgage is owned jointly by Jay and Barbara. It is not tax deductible. And we have linked this real asset to their primary residence. So where that is helpful is if they sell their residence in the future, any remaining amount on the mortgage would be paid off before the remaining cash balance would be invested or possibly used for another purpose. Okay, so now we're moving on to the government benefits page. I'm going to start with Jay here. So in accordance with his financial planning questionnaire, he has indicated to us that his Canada Pension Plan, his CPP, will start at the age of 65. Now, one thing you will notice that SNAP defaults to 56.87% of the maximum at age 65. But our clients have informed us that they are going to be receiving 75% of the maximum. So we're going to put 75%. Now, if you have received a statement from your client and you have the actual dollar amount, you can put that in here as well. So you can go with the dollar amount, or you can go with a percentage amount. And as for the old age security, our client Jay will be receiving that at age 65, 100%, and this is the amount that he will be receiving right in that field. Moving on to Barbara, she is going to take her Canada Pension Plan at age 63, and we also know that she is going to be taking 75%. So that's indicated right there. And the old age security, she'll take at 65, and she'll be taking 100%. So our clients do not have any insurance products, so we leave that blank. They don't have any education savings plans, so we won't be adding anything there. In terms of settings for the portfolio, that sort of thing, that's all standard, guidelined. Charitable donations, they have not indicated any. So we're going to move on to corporations, and they don't own a corporation. So once we get through all of this, we can click on done, and then this will bring us to our planning page. So I'm going to go on the combined planning page. And this is, just so you know, this is your client's life on one page. I know that it looks like a lot of numbers at first glance, but realistically, if you have your financial planning questionnaire completed, this will take you 5 minutes to create. And from here, you can assess if they are progressing towards their goals, and we can make changes in terms of contributions and that sort of thing, which we'll get into shortly. But for the time being, I just want to start by letting you know that there is a 3-level menu with Snap Projections. So this is our top level menu right here. So we are working within our clients. If we were to click on the word clients, it would bring us back to our client list. But we'll stay here for now. And we know which client we are working on because their name is showing here. And we know that we are working on their base scenario. Okay, so there is an opportunity to create multiple scenarios. Like we could copy, for example, this scenario, and then we could make changes and we could rename the scenario with those changes as something else. And then from there, we'd be able to compare those two scenarios, which we'll get to shortly. And then we have a little sheet of paper here. And this is just a notes section. And this would be for your view only. So any notes that you put in here that might be relevant to this scenario, your clients will never see. It's for your view. Okay, so I'll X out of here. The next level menu. So basically, Snap is comprised of 3 parts. So we have the scenario setup, which we've just completed, and really only takes 5 minutes if you have all the information in front of you. Then we've got our planning pages, which you can see here, and we actually have 3 planning pages. So we can see the combined page for both Jay and Barbara. We can see Jay's page only, and we can see Barbara's page only as well, right? And then we have our client report, which we will get into after, but we'll show you how you can generate a client report for your clients, which is very helpful. So now, like I say, the third level menu, we've seen that there's a combined page, an individual page for Jay, individual page for Barbara. We could also add a corporation from this page. We were able to do it from scenario setup. We can do it from this page as well. We can generate charts from this page, which I will be demonstrating later on. We can make recommendations from this page, which I will also be demonstrating later on. We can do some stress testing on our portfolios, and we can do some life needs analysis as well. Over here to the far right, we can export this planning page to Excel, and we can always run our scenario. So you'll see that anytime we make any changes to our planning pages, we will run the scenario so that it recalculates all of the data, and then we have the most current information in front of us. All right, so now what we're going to do is I'm going to give you an explanation or high-level overview of the planning page, and we're going to go from left to right to start. So we have the calendar years here, and then we have the ages of our clients in those calendar years. So starting the plan, Jay is age 60, Barbara is age 58. And then we have our cash flow management columns, which we have 2 cash flow managements. We have automatic cash flow management and we have manual cash flow management. The manual cash flow management is prior to retirement. We can see by this radio button here that our clients are retiring at age 65 and 63. So prior to that, we'll be entering our contributions manually, and any money that is left over will be considered spent during the manual cash flow. And then once we get to the automatic cash flow, which begins in retirement, this is where Snap will take a little more control over the assets and how we decumulate those assets. And we will look at that a little later on, but that takes effect at retirement. So then we have our expenses. So we've got our base expenses shown in real dollars, which means present value, today's value. And then we have our nominal dollars, which accounts for inflation. Okay, so inflation adjusted values in this column here. And then we have additional expenses where we can see the vacation of $10,000 a year, which is adjusted for inflation. Okay. Then we have our employment columns. So this shows the total employment right here. And if I expand on this, I can see that, and if I keep my mouse on this here, we can see that Jay's employment income is 90,000 and Barbara's employment income is 110,000, and those are adjusted for inflation. Then we've got our pensions. We can expand this as well. Oh, okay, well, anyhow, if we were on their individual pages, we would see the description of the pensions. But for right now, we've got the deferred benefit pension plan. And okay, and then the government benefits right here. Sorry, next column is what I meant. So we've got the CPP here, and we've got the OAS showing in these columns. Then we have a tax column, which I will elaborate on. So we'll see our taxable income, which if we want more information, we can click on this blue icon and we'll receive more details relating to our client's taxable income here, which is often very helpful when you're meeting with your clients. And we've got the CPPEI and the total tax, which again, I can click on that blue income and I can see information relating to federal tax, provincial tax, total tax. So that again is usually very helpful when meeting with our clients. Next, we move on to our financial assets. So we've got our non-registered assets, we've got our TFSA assets and our RRSP assets with a column for total assets. And we've also got this blue icon here. This is for our cash flow management order. So right now we want to show the cash flow management order for this scenario. So we're going to see here, once this populates, quick second here, save.
You only see it on the individual page, Jen.
Oh, thank you very much for that, Lee. Okay, so what I'll do, thank you, Lee, we will go to our financial assets page and we're under Jay's individual page to see that. So you'll see two columns here for cash flow management order. So in the contributions column, we will see that if SNAP is making contributions, the order will always be to registered plans first, then tax-free savings accounts, and then non-registered plans. And then if SNAP is going to be doing any withdrawals, then the order is the reverse. Okay, so they will follow the non-registered first, then the tax-free savings account, and then the registered assets. Now, any of these can be changed. So whenever you see anything that's in blue or purple, that means that you can edit that information. So if I click on this right here, I can edit the order to anything that I want here. Okay, so I'm going to leave it as is for now. But what I could also do is I could copy that change down to age 100. And then when you click on the blue icon with the check mark in it, then you're making that change to age 100. But I'm just going to X that out for now because I'm leaving it as is. Okay. Moving on in this column, so we can see the RRSP assets. Now this is the value as of December 31st. Right now we don't have any contributions being made, but we will get to that shortly. And the rate of return on that account is 3.8%. We have our tax-free savings account with a value of $88,230 as of December 31st. Same rate of return. And then we have our non-registered account. Now, keep in mind, we're on Jay's individual page, and we had said that the non-registered account was a joint account. So half of that account is showing on his page, and the other half will be showing on Barbara's page. All right, then we have the real assets. So we have the primary residence, and again, because it is held jointly, we are showing half of it. I'm going to go back to the combined page to show you the full amount. So this is the full amount of the real asset here. And then debts, we have a mortgage owing on that. Now this, we had said that it was 72,000 owing, but at the end of the year, after they've paid the 14,400, this is what the amount owing will be. And then we have our balances columns. So we've got a net worth balance, and we've got an estate before tax balance, and then the tax on the estate. Now, if you click on these two, you will receive a summary table. So I'm going to start with the net worth summary table. So, and again, there are 3 columns to this. So we'll look at combined for now. But as of December 31st, it shows us what the financial assets are, the real assets, the total assets. It shows us the debts, and then it tells us what the client's net worth is at the end of that period. And then moving on to the estate before tax summary. Okay, we've got another summary table here. So I'll be looking at the combined column. So we can see the total assets, we can see the debt, we can see the estate value before tax, we can see the tax on the estate, which is 267,600, and then we know that our after-tax nominal amount is $975,308. So those are very interesting tables to look at. Now, if I want to,
Yeah, and I'll just jump in. And you can see any year by clicking that year's value, or you can click the menu at the top under estate before tax to see the final year.
Very good. Yes, thank you for pointing that out, Lee. If we click on this icon here, we will see the value at the end of the projection. So when Jay is 100 and Barbara is 98, that'll be December 31st, 2065. We can see under the combined column that they actually have a deficit here with this projection as it is, with basic living expenses of $115,000 a year. Okay, we will assess that again once we make some recommendations, but for now, as is, we're in a deficit. Thank you very much for that, Lee.
Great.
All right, so now we're going to make some contributions, and I'll show you how to do that. I'm going to go onto Jay's individual page, and based on his financial planning questionnaire, we are told that he is going to be making TFSA contributions in the amount of $7,000. So in case you didn't notice, I clicked on the 0 here under the contribution column under TFSA, and I am going to input the amount of $7,000. I am going to click on this to copy this down to age 64. He's going to make those contributions until 64 because he is retiring at age 65. And I will click on this blue icon here to factor that in. Now you will see right away that I've got an orange highlighted message here that tells me that this scenario has been changed and to please run the scenario with the updated result. So that means I've got to click the run scenario button. Remember I had told you that it was green. I had showed that it was green. When this button is orange, that's because you've made a change and you have to click on it so that everything can be calculated behind the scenes. So we're going to do that now. The button is green, and so we can see that these changes have been factored into the plan. Now, if we wanted to erase those, let's say we wanted to erase just one of those, we could click on this X and it would erase it. But let's say we wanted to erase all of them, then we could click on the first one, the 7,000, okay, and we could click on Clear Override. And we would copy that down to age 64, and then that would erase those numbers that we had just put in. But I'm not going to do that, so I'm just going to X that out. But if you wanted to erase all of those, these are the steps you'd follow. And then of course, you'd click on this check mark button. All right, and our client Barbara wishes to do the same thing. So we're going to go to her tax-free savings account right here, and we are going to input TFSA contribution of $7,000 to age 62 because she's retiring at age 63. We're going to click on this blue icon with the check mark. And again, we've got this orange message notifying us that we must run the scenario. So we will do that. And that is done. So now I'm going to go back to the combined page and we're going to look at it now from top to bottom. So as I pointed out, the clients are retiring at age 65 and 63. And this is where we start to see some withdrawals in the plan. So you know how we had talked about the withdrawal orders? We can see that they're going to start by withdrawing from the non-registered accounts in the amount of $24,100 and the tax-free savings accounts in the amount of $31,603. And then the non-registered account will have been fully depleted in year one. So then they will be withdrawing what they need from the financial asset of tax-free savings account. And then you will see that at age 71, well, I guess we can tell that they had to convert their RSP to a RIF before age 71. Looks like they did a little earlier because we start seeing withdrawals from the RIF at age, oh no, okay, sorry, I was not looking at this right. Yeah, so at age 71, we are converting, at the very least, Jay's RSP to a RIF. And then at age 72, we start seeing that he's got a withdrawal from his RIF of $45,058. So you can kind of see how the cash flow management works, and it also takes into account the minimums on those RIFs once they reach the rollover rate age.
And you can expand that financial assets on the combined page to see the individual withdrawals as well. The combined page is great to see a summary. The individual pages are where you want to go to make changes, but
would you like
here, yeah.
Okay, so let me go to Jay's page, and this will be a little easier to view here. Okay, so so we can see that he retired at age 65. So prior to that, it was automatic manual cash flow. So we manually inputted his contributions. At age 65, we went into automatic cash flow. And this is where we're starting to fund his retirement need of $115,000 a year, which actually his portion is less because it's split between the two spouses, not 50-50. It looks at a variety of things, including income and their assets and things like that. But anyhow, for his income that he is generating from his investments, we can see that age 65, he's taking $11,731 out of the tax-free savings account, and he's taking $12,050 out of his non-registered account. The following year, age 66, the non-registered account has been depleted, and he's then taking more out of his tax-free savings account. Then at age 71, we can see that his RSP has been converted to a RIF. And then by the age of 72, he takes his first minimum RIF payment of $23,175. And then he also takes an additional amount of $21,993 from the tax-free savings account. So
I think his RIF money might be a little bit more than the minimum. If you hover over that 23,000, it shows you the minimum is only $12,391, but because his his TFSA has been depleted, he has to take more.
Exactly. So as we can see here, the tax-free savings account actually depletes in this year. So we're not able to meet the need by just taking the minimum withdrawal from the RIF. So we've actually had to take more to meet that need. So yes, thank you very much for pointing that out, Lee. And yeah, so I'm going to go back to the combined page for now, just so we can see if the plan works. So if we scroll all the way down or down until we get to this section here, we can see a red highlight, which is basically telling us that the client is in a shortfall of $27,539 at the age of 87 and 85. Okay, so as of this point in time, they are in a deficit. So we see that through the net cash flow column, and then with the cash balance column, this is the amount every year right here that they're in a shortfall by, and then the next column shows the accumulated amount of the shortfall. So to answer our client's question at this point, if they want to know if they have enough money to meet their spending need of $115,000 per year during retirement, the answer is no, they do not. They actually start running out of money at the age of 87 and 85. So technically, we could, because this amount here under the base expenses is in blue, we could play around with this. We could play around with different numbers and see what works and that sort of thing. But we also have recommendations, which we'll get to. Before I go to recommendations, I'm going to show you a couple of our charts. So I'm going to go up here, center page, top center page, and click on charts. So the first chart that we're going to look at is our cash outflow chart. So basically this shows us where the client's money is going. So if I hover over base expenses, which are in purple, only those base expenses will show. So that's the amount of, that's the $115,000 that we see coming out every year. Then because we had selected to show the vacation in our charts, we have a separate legend item for that. So we can see in blue the client's vacations every 3 years. We see the amount of income tax that they are paying every year. We see their debt repayments, and we see their financial assets. Now, we could also click on any of these to remove them if we didn't want to show them. So let's say we didn't want to show the vacations anymore. We could click on it, or we can click on it again to bring it back. And then we see our total inflow of cash, okay? So basically we can see that the client here is in a deficit at this point here. All right, at the age of, let's say 87, they start, or Jay's age 87, they start being in a deficit because they are spending more money than they actually have coming in. So this is a nice chart to show your client, and you can hover on any of these bars to get information relating to that period. Now you can also click on the menu and you can view the chart in full screen. You can print the chart, or you can download it into a PDF or other format. We also have another chart that I like to look at is the net worth chart. So again, we can see the non-registered assets. It doesn't show because they're insignificant here. But yes, they do have non-registered assets. We see the TFSA assets in green, the registered assets in blue, the real asset, the family home in a darker shade of blue, the debts, and they don't have any insurance products. And what we can see with the dotted line is we can see where we can see their net worth, okay? And we can see that going down over time as they deplete their assets during retirement. Okay, now I'm going to close these charts off, and then I'm gonna go into our recommendations tab. So you will recall that the client was in a deficit at age 87 and 85. So they are unable to sustain their retirement with living expenses of $115,000 a year. So if we go into recommendations, they do provide us with this retirement summary here. So we know that our clients want to retire at age 65 and 63, and they're hoping for $115,000 a year, but with that, their plan is underfunded. And the total shortfall brings them to negative $1,115,388. And in terms of progress towards their goal, they're only at 88%. So there's a few things we can look at here in recommendations: retirement age, maybe retiring earlier or later, that sort of thing. We can look at required lump sums, required savings, and our most popular feature is the sustainable spending. So this is going to let us know the maximum amount that our clients can spend at retirement without running into a shortfall. So we're going to calculate this, and you'll notice that these ages are in blue, so they are editable as well, but we're going to leave them at the retirement ages of 65 and 63 for now. So we'll hit calculate. All right, it doesn't take very long. You get an answer, and the answer is that they can spend $105,675 per year, which is really only $9,325 less than they had planned at $115,000. So before we apply and run this, we are going to click on copy the scenario. By copying the scenario and then hitting apply and run, we will then have two scenarios. So we're going to copy it, we're going to hit apply and run. And now we have two scenarios for our clients. We have the base scenario that we looked at where they were spending $115,000 a year, which led them into a shortfall position. And then now we're in to the next base scenario with sustainable spending. So we can see here that the $115,000 that they were using as a base expense has been reduced to the sustainable amount of $105,675. All right, and if we scroll down to the bottom of the page, we will see that there is no shortfall. Nothing is highlighted in red, and therefore the plan works. Okay, so before we go and compare the scenarios, what I'll do is I'll show you these net worth and estate before tax summaries. So if I go to the net worth summary in the final year of the projection, so we can see under the combined as of December 31st, 2065, the total assets are, and this is with the sustainable plan, $1,290,322, and they have a net worth of the same amount because there's no debts. And then if we go to the estate before tax in the final year of the projection, we can see that under combined, the estate before tax is the same. They have tax on the estate of $304, and so their estate after tax is $290,018. So now let's do a comparison of both those scenarios. So if we go up here to this menu icon, we can compare the scenarios. So I'll click on that and I will select both scenarios. So that's the base scenario and the sustainable spending scenario. And then I will click on compare. So as you can see, we have these metrics. We have the base scenario column, the sustainable spending column, and then we have a column for the difference. So I like to look at this from the point of view of the personal estate. And so we can see here that with the base scenario, they are in debt at the end of the plan. All right, so they would have a liability of $1,115,388, whereas with the sustainable spending plan, they will not have any debt. Okay, and then if we look at the estate before tax, in the base scenario, their estate value is $174,000 versus $1,290,000 in the sustainable spending scenario. And then the tax implication is $0 on the one, $304 on the other. And then the estate after tax is significantly more under the sustainable scenario, to the tune of $1,115,915. So it's very interesting to look at it on a comparative basis. And then, so this is under the summaries tab, but we also have a trends tab that you can look at. So we can see the trend here, how it's trending, how both of these scenarios are trending. So that you might wish to show to your clients as well. Okay, so this was at the base expenses. So these are a little bit less with the sustainable spending. In terms of expenses, again, a little bit less. But then when we look at the tax situation and we look at the value at the end, it's a noticeable difference. So, and again, you can print this if you like. We will exit this now. And then the next stage is creating our client report. So we will click on this in our second level menu. And this brings us to the report editor page. Now there's 3 sections to creating a client report. There's the report builder, the report editor, and then the report preview. We always start at this page. Now, if it's your first time working with Snap, you're going to want to fill in your information here. You're going to want to upload your company logo. You're going to want to select your background for your report. And you can always select to save these settings for any future scenarios, which is nice. And then we're going to go to the report builder page. And this is where you can select which pages you wish to include in your report. So we have the included pages section, and these ones are the pages that come from the gallery. So the gallery would really show you all the pages, but you can see that they're all selected because they're all stroked off. But if you wanted to remove any pages, you would just slide them into the gallery. And then if you decided that you wanted them, you would just slide them back into the included pages section. And then you can change orders of your pages as well. Very easy. You just slide them up and down to suit your needs. So these are all the pages that are included or could be included in your reports. We also offer custom pages. So if you wanted to customize any type of information that you think your client might need. And then we have header settings if you want page numbers, and then of course print options, that sort of thing. Once you've selected all your pages, you go to your report editor, and this is where you can make changes. So in the snapshot section, for example, under goal summary, you can make any changes here. You can add information, anything like that. If we were to go under the recommendations page, you can have anything relating to recommendations, maybe consolidating assets, changing your asset allocation, making improvements that way, talk about their spending, that sort of thing. You can do all of that through the recommendation page. And then once you've got all that looked after, then you can go to your report preview. So this is where you can actually see the report before you might want to print it or email it out to your client. So this gives us a high level overview here with these snapshots that we've selected. So these snapshots are more or less summary cards that are included in the reports. And these are generated because we've used the recommendations tool. So for example, we can see that with the sustainable spending, our clients are 100% funded. So these are really nice. These are actually one of our newest and most popular features that our users like to present to their clients. But then you can see, you know, there's a wide variety of reports that you might wish to present as well. And then from there, oh, I should mention to you as well, even though we're in English, you could generate your report in French if you had a client who was French speaking. And so that's another option that you might come across and need. So then from there, you can generate your PDF and you can save it, you can print it, or you can email that to your clients. So aside from that, that is how you would set up your clients and present them with their client report. And over and above that, if you need any help along the way, we have the word help on the top right-hand corner of your screen. If you click on that, you can click on our help center. And from there, we have our telephone number that you can reach us at. You can also contact us through our portal here. You can you can send us an email at support@snapprojections.com. And we also have these tiles here with a wide range of information. So if you went into Start Here, for example, we have some articles. We have your financial planning questionnaire that you might need, that sort of thing. I'm going to go back to that page. If you wanted information on RESPs, for example, or RRSPs, you could just type in RRSPs and you'll get a long list of articles pertaining to RSPs that might be helpful to you. So there's lots of support in terms of the functionalities of Snap and getting you going with the product. So that would wrap it up for now. If you have any questions, just get a hold of us. We're pleased to assist you. And we have a whole team dedicated to supporting you and ensuring that you are very successful with Snap. Thank you.